Well, this wasn't just another down week for the Indian markets. This was a serious reality check. A huge wave of selling completely wiped out that post-budget rally. And honestly, the big question isn't just if we're going to bounce back, but what on earth happens if we don't? We're going to break down all of it, the fear, the money flows, and the critical levels you need to watch. Let's get right into it. So here it is, the number that pretty much defined the entire week, a massive 961-point drop in the BSE Sensex. Look, this wasn't a slow trickle. This was a sharp, aggressive move down that completely snapped the market's recent good mood. Let's really unpack what happened and, more importantly, why. Okay, so let's start with the big picture. This sell-off was significant. And the key thing to remember here is that the markets didn't just dip a little, they fell hard enough to erase all of that optimism we saw after the budget. We landed right back at those crucial low points. Now, this slide really shows you that the damage was everywhere. The Sensex, the Nifty, and even the super important Bank Nifty all ended the week deep in the red. This wasn't just one sector having a bad day. This was a widespread risk-off move across the entire market. That means investors weren't just selling one thing to buy another, they were selling pretty much everything to move into cash. This all leads to the one question that everybody is asking. What was the trigger? Why did the market, which seemed so strong just a week ago, suddenly crack under pressure? And this is where the story gets really, really interesting. It was really just a perfect storm of bad news. On one hand, you had weak signals coming from global markets. But the real jitters, they came from geopolitics. When major talks like the US-Iran negotiations break down, it sends ripples of fear through the market about global instability and potential oil price spikes. Now, you mix that with this growing, massive uncertainty around AI and its impact on our biggest export sector, IT, and you've got the perfect recipe for foreign funds to just hit the sell button and ask questions later. And, this quote here from Vinod Nair at Geojit Investments, it just perfectly captures the mood. That phrase, a risk-off tone, that's everything right now. It tells you that investors have totally shifted their mindset. They're no longer chasing big returns. They're trying to protect their capital. It's a huge psychological shift in the market. Now, let's zoom in on what I think was the epicenter of this entire market earthquake, the Indian IT sector. Because what happened here wasn't just selling. It was a full-blown meltdown that has sparked this massive debate about the entire future of India's biggest tech companies. Just take a second and look at this number. In the month of February alone, 5.7 lakh crore. That is how much investor wealth just evaporated from the Nifty IT index. To put that into perspective for you, that's the biggest monthly drop we've seen since the 2008 global financial crisis. So yeah, this isn't some small correction, this is a historic plunge, and it's all being driven by one massive fear. And that fear? It's got a name, the AI fear trade. It's this powerful, compelling idea that generative AI won't just be another tool for Indian IT to use, but that it could actually replace a huge part of what they do. The big concern is that AI could completely take apart the outsourcing model, leading to a permanent squeeze on what they can charge and, of course, their profit margins. And this slide right here, it perfectly shows the two-sided battle that's raging in the IT space. On one side, you've got the bulls, the value hunters. They're looking at valuations that are at an 8-year low, and they're basically saying, hey, the fear has gone way too far, all the bad news is already priced in. But then on the other side, you've got the bears, and they argue this isn't about valuation at all. They think it's a structural business crisis. They believe AI could permanently shrink the industry's profits. And this view got a huge boost from a shocking report from Jefferies, who are warning of a potential 30 to 65% further derating. That basically means they think the market could start valuing these companies much, much lower in the future. So, with all that chaos, what are the key levels to watch? Well, this 33,800 to 34,200 zone on the Nifty IT index, that's the line in the sand. If the index holds here, it's a sign that buyers are finally stepping in to defend it. But even if we do get a bounce, that 37,000 level is going to be a massive wall to climb. Bottom line, until the IT index can convincingly get back above 38,500, the sellers are still driving the bus. Okay, so with all of this intense selling, you have to wonder who was on the other side? Who was actually buying? Let's follow the money, because looking at who bought and who sold this week gives us a really important clue about the market's internal strength or its weakness. And here it is, the classic tug-of-war we've seen so much lately. The FIs, the foreign institutional investors, were net sellers, pulling out almost 3,500 crores. But And this is so important. Our domestic institutions, the DIIs, they stepped up in a huge way, buying over 5,000 crores worth of stock. They literally acted as a powerful cushion, absorbing all of that foreign selling pressure. And when you look at the top losers for the week, it just confirms that risk-off feeling. We're seeing profit-taking in normally safe sectors like pharma with Sun Pharma, telecom with Bharti Airtel, and even the auto sector with M&M, which had been so strong. This wasn't about one specific bad story. This was about investors just trimming their risk across the board. But here is where things get really weird. In a good way. Right in the middle of this IT sector bloodbath, two of the week's top Nifty 50 gainers were HCL Tech and Infosys. Now that is a fascinating signal. It tells us that while a lot of investors were panic selling the entire sector, some other, probably smarter money, was selectively buying the blue chip leaders, betting that the sell-off was overdone. All right, so that was a look back at a pretty wild week. Now let's switch gears and look forward. Based on everything we've seen, what are the key levels and the major themes that you absolutely need to have on your radar for the coming week? For the Nifty 50, it really all comes down to these levels next week. On the downside, 24,982 is the major support. If we break that, things could get ugly fast, and we could see a quick slide down towards 24,855. On the flip side, if the bulls try to stage a comeback, they're going to run into a wall of sellers right around that 25,400 mark. So, in a nervous and uncertain market like this one, a classic defensive strategy really starts to make a lot of sense: dividend investing. The idea here is pretty simple. In a choppy market, owning companies that pay you a regular income can be both a psychological and a financial cushion against all the volatility. It's literally a way to get paid while you wait for the storm to pass. And with that strategy in mind, March is actually shaping up to be a pretty interesting month for dividend investors. We've got several really solid companies that are on the calendar, and here are 4 that are definitely worth putting on your watch list. And here are the all-important details. You've got Castrol India, SBI Life, and Naperville Investments with their dividends already declared. Engineers India is on deck as well. Now, the most important column on this entire slide is the record date. You absolutely have to own the stock before this date if you want to be eligible to get that dividend payment. Don't forget that. So, that brings us to the big question I have for all of you watching. We've looked at the data, the global jitters, the intense AI fear, and that strong domestic buying. When you put it all together, what's your call? Do you think the Nifty is going to break that crucial 24,982 support? Or will our domestic institutions win this tug of war and trigger a bounce? Let me know what you think. Drop your analysis in the comments below. And that's your weekly market debrief. Hey, if this data-driven breakdown helped you connect the dots this week, do me a favor and hit that like and subscribe button so you never miss an update. In a market that's caught between intense fear and deep value, staying informed isn't just an advantage, it's your best defense. We'll be back next week to track the data. Until then, trade smart.